Rudramurthy joining in on the technicals, and we've also got with us Siddharth Vora, who's with us from Prabhudas Leeladhar, who will be joining in.
Siddharth Vora, the Head of Investment Strategy and Fund Manager PMS at Prabhudas Leeladhar as well. Siddharth, hi, good afternoon. Thank you so much for making time. Let's continue that discussion that we were having on the IT pack. TCS, of course, disappointed with its Q1 performance, and that has soured the move for the entire space as well. Do you think it's reflected in the price enough, or do you see further cuts coming both in terms of target price as well as EPS going forward?
Okay, so I believe price correction could largely be done. Time correction is more likely from here on. I think post TCS results, volumes have tapered. Realizations will and need to be adjusted higher as we go along. And there are serious cost headwinds in terms of on-site wage inflation, attrition rate, travel resumption, etc. that will keep margins under check. I also believe productivity can go up incrementally as freshers start contributing. New hiring numbers, though, do suggest that TCS is showing some sort of weakness on a sequential basis. But the growth outlook in new orders seem resilient, though decelerating. They are still resilient enough on an absolute basis. On a relative basis, could be decelerating. But now, when we package all this with valuations definitely seem to be at the higher end of historical bands, and therefore there could be some sort of derating that the Indian IT pack goes through to adjust to the new growth and margin regime. While all of this is likely for the next 6 months to 1 year, we still believe the structural growth story of IT of India is intact, and we could see time correction as other sectors become more attractive in the near term. So IT will definitely not be the most favored sector here. But I believe for a long-term investor, IT is still a relevant sector to build as a core position.
Move on then, Siddharth, let's get in your take as to what the outlook is when it comes to the entire auto space. Earlier this morning, we were interacting as well with Vineet Sambre, who said that he is very bullish on the entire auto ancillary space, believes that there's a lot of potential within some of the OEM names, and that the tide is really turning within the auto sector. Would you tend to agree?
Absolutely. I think auto is and has been quite an overweight in our portfolio since a while. I think to decompose the entire auto play, I think the CV cycle is absolutely strong and resilient, and the outlook also remains to be good. And it's a highly consolidated two-three player market. So there are a lot of opportunities there. We also believe that the passenger vehicle segment has seen strong, healthy order books, a lot of new product launches from all sorts of players, which are doing very well. Now, as raw materials are cooling off, hard metals, crude, everything is cooling off, there will be margin triggers and tailwinds. As also the supply chain normalization, the chip shortage issues being resolved, I think all the OEMs will be able to better serve their existing order book. Our top picks and key stocks in this space are Motherson Wiring and Tata Motors. We own them in our funds, and we believe both of them are absolutely well placed from a near-term visibility and from a structural growth visibility as well. Motherson Wiring, because it's an absolute elephant in the wiring harness business, and 50-55% sort of ROE, highly free cash generating business, I believe yet to be discovered by the street because of the new demerger and listing. But we believe it is one of the nicest stories out there to play the entire auto revival with structural profitability, clean management, debt-free balance sheet, etc. Tata Motors, on the other hand, has a lot of tailwinds in terms of the CV cycle doing well, the domestic SUV presence in the passenger vehicles supporting really well on market share gains and all volume outlook as well. Now, with the M&M EV deal that happened last week, we also believe Tata Motors EV business should get reflated in terms of its valuation perspective, because Tata Motors has a big edge compared to most of the other players in the domestic EV ecosystem. Also, the JLR platform SUVs that Tata Motors is launching and the new launch pipeline is very, very strong. So we believe it's probably going to fire on all guns. And as China also resumes post-COVID, we think that should support JLR volumes at a global level. So I think, yes, auto is a great space to be in, and our picks are mainly Tata Motors and Motherson Wiring there.
Siddharth, just wanted to get in your take because the Steel Ministry is in favor of this reduction in duties, saying that demand as well post-monsoon is likely to pick up. How do you believe this is likely to change things fundamentally?
So I think metals as a sector is grappling between too many headwinds and tailwinds at the same time. Headwinds in terms of recession, prices cooling off, Europe demand coming down, and tailwinds in terms of some of these duties, coming off. And I think 1 month ago or 3 weeks ago, when the export duty was imposed, that was quite a party pooper for the entire Indian ferrous metal space. So as a trade, I guess metals could be looked at if you're confident on how to really navigate this piece. But as an investor, I don't think I would be very gung-ho about being overweight on metals at this point of time, leaving aside maybe a name like Hindalco, which also has some more consumables in its portfolio rather than just a pure commodity play on ferrous metals itself. Because there's the China angle, the US angle, the Europe recession angle, the raw material prices, which are now cooling off, which might help them a little bit. But overall, the volume and realization scenario, I don't think is extremely favorable. And playing metals just because of these regulatory changes, I think that's going to be a tough trade. You have to be very, very nimble-footed to be able to pull that off with good comfort. So that's my view on metals.
Siddharth, wanted your take regarding this entire electricity pack. We just discussed how the prices are likely to go up, but renewable is something which seems to be coming back to the foray after a bit of a lull in between. We have JSW, which is looking at a transaction today. There were reports that NTPC is looking at some value unlocking as well, and Power Grid has been quite active as well on account of some of the transmission bids that they have won. Given the volatile environment we are in, do you think these defensives can be a good bet to be taken in the portfolio?
So the power pack on the whole, like the green energy, renewable energy power pack, I believe these are concept stocks where obviously the structural demand, the opportunity size is very visible. But I believe cash flows are going to be extremely tail-ended here. And if the investment horizon is very, very long and the research depth and conviction is extremely high to be able to write these stories for like 5-10 years, then these are good places to be in. We are playing the whole energy ecosystem via 𝐸𝐸X, which we've recently added. And we believe that is the most capital efficient way to play the Indian energy market, with high ROEs, high cash flows, zero requirements of capital to scale up the business, and with new products and new term contracts coming in on stream, and the regulatory environment also turning more favorable for the energy exchange space, we believe that is the way we are planning to play, and we do plan to play the energy ecosystem for India rather than the power generators themselves.
All right, Siddharth, thanks so much for
energy ecosystem for India rather than the power generators themselves.
All right, Siddharth, thanks so much for joining in and sharing with us your assessment and outlook on the markets. Time to take a very quick breather right here on the show. Stay with us for lots more.